We have Phil Strebel in the pits of the CME Group in Chicago. Yu-Dee Chang telling us why he's getting out of stocks and into cash. And also Charlie Smith, he'll break down why it's time to call on telecom stocks for profits. Let's start out first with our friend Phil Strebel down at the CME Group in Chicago. Phil, right at the end of trading today, we saw nearly session lows. Seems like there's a lot of cautious attitude coming from the marketplace right now. Is this all earnings?
Yeah, I think the traders are concerned about earnings going forward. I mean, there's no reason if you caught any of this move upwards in the S&P over the last several months to stay in there and to risk it. I mean, you got concerned about a slowdown over in China. You've also got the IMF revising lower global growth. And a lot of people are concerned again about Europe, whether Spain and Greece are going to request that bailout. So I think if you're overweighted, definitely look to step to the side. I mean, we may retest that 50-day moving average down around 14.18.
On the other hand, Phil, you're talking about expectations. It's all an expectations game. And when you look what happened to Yum Brands today, they had a little pop after hours yesterday with their earnings. But when investors focused in on it and found that a lot of their good earnings were coming from China, despite the slowdown, you know, people began to look a little more optimistic.
Well, I mean, if you look at something like Yum Brands, I mean, obviously people are going to have to eat no matter what. And I think that Darden prices their restaurants in favor for, you know, the average person who can afford it. If you start looking at larger ticket items like aluminum coming out of Alcoa like yesterday, those are big purchases. And I think a slowdown in China is directly going to impact that and not as much on the, you know, the restaurants and the food side.
Phil, you also have your ear to the ground when it comes to oil prices, and oil was very volatile in today's session, but we are still looking at prices hovering around that $90 level. We're going to be talking to Fidel Geit a little bit later in the show. In your opinion, where do you see oil prices fairly valued now that they're back above $90 a barrel?
I still think they're right in a range, like an 88 to 92 is the fair value given the supply-demand fundamentals. The big risk is to the upside on geopolitical risk. You look at, you know, this confrontation with Syria and Turkey. There's a major pipeline that goes right through that border that pumps about 1 million barrels per day. And if that's impacted in any way, you could see oil start to move back up to 94, 95, and maybe even above. I don't agree with geopoliticals driving the prices given the fundamentals, but it's here and it's something we're going to have to deal with.
Got it. Phil Strebel from the pits of the CME Group in Chicago. We'll come back to you when this S&P 500 pits
I gotta
close.
ask, do you ever get nostalgic for those pit scenes back when you hear the screaming?
I wish I was there right now. No, David, I love being right here next to you.
Thanks, Phil. Good to see you. Well, let's bring our market panel into the discussion. Joining us now, Yu-Dee Chang, Ace Investment Strategist, Chief Trader, and Charlie Smith, Fort Pitt Capital Group CIO and Principal. Good to see you both. Yu-Dee, I want to go. Let me ask you about China, because we were just talking about Yum Brands. They specifically mentioned the reason they did so well, much better than expectations, was because of the revenue that they were getting from China, from their Chinese, the rollout of their Chinese operations. That runs kind of counter to the conventional wisdom that China is going to slow down tremendously, doesn't it?
Yeah, you know, I think Phil's right. First of all, I agree with him that Chinese people really loves to eat, right? So whatever the side, food-wise, that should do well. But, you know, you hit on a good point. You know, it's actually a very interesting point. Slowdown of China, everybody knows that, right? So most people are saying that we're seeing pretty much the worst of it, well, the end of it, that this 7.5% growth is pretty much the low, and from this point on, they'll revert back and start coming back up, saying that they're slowing down, but they won't be a hard landing. To me, that is the key point to see. I think if China does stabilize from here, it's going to help out the world economy tremendously, but in my opinion, it still remains to be seen. It's not quite sure. I'm not quite sure China will definitely hold this 7.5% level, though.
And Charlie, you see reason to play defense heading into the upcoming election. In fact, you say there's a way to play if Romney wins or if President Obama wins. What would that exactly be if there was various outcomes of the election, obviously?
Well, if we get a win for Mitt Romney, I think the chances are that capital that I believe has pretty much been on strike for most of this year is going to see the potential for a better economy in late 2013, 2014. The first year of any new administration doesn't tend to be that good of a year for the market or the economy. But I think the markets would definitely see the possibility to come off the sidelines, capital coming off the sidelines in the latter part of next year and into 2014. As far as an Obama win, you had a previous guest talking about how a win for Obama has pretty much been discounted. But I think if we do see an Obama win, it's going to be pretty much capital still sitting on its hands for the next 4 years. I know that's a difficult proposition, but we may see it.
Well, so Charlie, let me just get it straight. If in fact Romney wins the election, Obama's out, that means that the fiscal cliff is resolved, right? That means the taxes are not going to go up. And therefore, you think all of this cash is, because we have seen great market gains, but it's been on very low volume. You think that will change and the volume will flood into the market?
Yes, I do. And I also think, even more importantly, is the potential for Romney to reverse Obamacare. I think particularly for small and mid-sized businesses, the amount of unknowns out there in terms of employment regulation is really sort of causing small and mid-sized business people to just sort of fold their tents right now. And I think if we do get a Romney win for small and mid-sized businesses, that's going to really free up some activity.
Now, Yu-Dee Chang, I'm looking at the S&P 500. We closed at 1432 today. You're saying it's time to get out of stocks and into cash. However, is there a level to which this market can fall to where you would be a buyer again?
Yeah, absolutely. Actually, I'm long-term bullish. I think we're in this down cycle of this uptrend. So short-term, I'm looking right at that 1,400 level. If you look at it, that's about what? About 5.5%, 6% so-called retracement. And if you look, this market has gone up about 115% since March of 2009. But during which we have had 12 pullbacks already. This will be the 13th one. On the average, it's about 7% or so. So I like the 1,400 level. And also, I like two different sectors. I tell you, that has nothing to do with election, who wins or not. One is the precious metal. Heads you win, tail you win. With all the money pumped into this market, inflationary pressure down the road, you got to buy metals. Or somehow the world economy does not hold here, then there's turmoil, you got to buy metals. And the energy market, I agree with Phil that the energy, if you look at it, basically is very volatility going nowhere between 80 and 110. You got to buy the low end, sell the high end, and use some type of neutral strategy in the middle. Okay. Right now, we're in the middle.
Charlie, let me get to your picks. I'm looking at Comcast, AT&T, Verizon, Boeing, Honeywell. To me, that sounds like picks of a bullish economy. That is an economy that's ready to get going again. You're talking about Boeing. You're talking about the telecoms, Comcast, Honeywell. Am I right? Do you think that the economy is on the verge of doing better than it has been, which is minimal at best?
Well, I view the telecoms as a good way to play defense and the aerospace names as sort of trying to capitalize on the growth in worldwide air traffic. But obviously, Comcast has seen an improvement in the ad market. The cable cut, or the cord cutting phenomenon, which people were so worried about for the cable business, has just not happened. Meanwhile, there's good growth in wireless. The iPhone is going to hurt the margins for the big players, Verizon and AT&T, here in the next couple of quarters. But they're also getting nice price increases for data services, and that's going to drive revenues here in 2013 and 2014. So we view the telecom as mostly a defensive play, and the aerospace companies as a little bit better way to play worldwide air traffic growth and play offense.
Hey, guys, great analysis, great overview, and very good specific picks as well. Charlie Smith, Yu-Dee Chang. Thank you, gentlemen.
Thanks, guys.
Pleasure.
JP Morgan and